When it comes to building up wealth, many people don't know where they should start or what is important. That's why today we give you some very basic tips on what you should pay attention to, especially at the beginning. Set clarity and order in your finances. This is important, especially when you're just starting out. You first have to take care of the basics. Why is this overview so important at the beginning? Only if you have this overview will you know whether you have any money left to save at the end of the month, or whether you're possibly spending more than you earn. How do you do this? The easiest way is to keep a budget book for several months. You can do this in a paper list or with a special app. There you list all your income and expenditure. And such a budget book also shows you immediately how much is left to save, or if you have to reduce costs first before you can save anything and then invest it. In such a list, long forgotten items quickly become clear, like a subscription that you wanted to cancel a long time ago. You can then immediately eliminate such big money guzzlers and unnecessary expenses. Part of this tidying up is also getting rid of your debt. In the long run, debt is not only annoying but also expensive. If your current account is in the red, you pay the bank overdraft interest. Therefore, the best thing to do first is to get rid of your debts if possible. Don't give away returns. You're already putting money aside regularly? Then you have already taken the first important step to build up wealth. The crucial thing now is to do the right thing with your savings. If you leave it completely in a current account or savings account, it will not get you anywhere because the prospects for returns are far too low. On the current account, there's usually no interest at all, while on a savings account there is interest, but in most cases it's lower than the inflation rate. That means you have a negative real interest rate. What does this mean? Interest rates may slow down the gradual loss of value of your savings, but they do not stop it. Building up wealth is not possible in this way. This by no means means that your current or savings account is pointless. On the contrary, it has two decisive advantages. You can access the money at any time, and the money is not subject to the fluctuation of investment on the capital market. That's why your emergency reserve for unplanned expenses also belongs in your current or savings account, for if the dishwasher breaks down or the car has to be repaired. This liquid emergency reserve should in any case cover your needs for several months. Some say that 3 net monthly salaries belong there. You should invest what goes beyond that, what you really want to use for asset accumulation, with the prospect of gaining higher returns. The capital market is a good place to do so. Spread your risk. This is one of the basic rules when you start building up wealth. Diversification is very important. That means don't put all your money into one asset, one stock, but you spread your risk. It is generally possible to invest in a broadly diversified way with ETFs. ETFs are exchange-traded funds in which you invest in a broad stock indices. For example, there are ETFs on the MSCI World. This share index tracks the performance of about 1,600 shares from 23 industrialized countries, and when you invest in such an ETF, you're investing in a whole basket of securities with one purchase. There are two ways to set up such a broadly diversified ETF investment. One way is to select one or more ETFs yourself, buy them through your broker and add them to your portfolio. The second way is, if you say this is too much effort for me, you can also delegate this task to your wealth manager. They will put together an ETF portfolio for you for a small fee and manage it for you. This means that you pay money in, the wealth manager selects the ETFs, puts the portfolio together according to your specification, and manages, monitors and rebalances it if necessary. An example, if you chose an ETF portfolio with a 70% equity share in the asset management, then the wealth manager monitors it for you and always rebalances it if, for example, the weights of the ETFs have shifted due to price movements in the market. Then the selected equity share of 70% is always restored. The share is the proportion of shares in the portfolio. I have chosen 70% as an example. You should be aware that a higher equity ratio tends to mean the prospect of higher returns in the long term, but can also be associated with higher risk. Whether you select ETFs yourself or your portfolio is managed by a wealth manager, in either case, ETFs can be used for broadly diversified investments. Don't misunderstand this as a general objection to individual stocks. You can include individual stocks in your portfolio, but if you invest exclusively in one or only a few stocks, then your risk is concentrated there. A basic tip: think long term. Wealth accumulations is not something that happens overnight. On the one hand, as mentioned before, you always have to expect fluctuations on the stock markets. This can also be illustrated with the example of the MSCI World. Investment in ETFs on the index have generated an average annual return of around 9% since 1975 until 2019. Anyone who has invested in the MSCI World for any 15 years in the past decades did not make a loss, regardless of the time of entry. Depending on when they bought and sold, however, the returns varied greatly. On average, measured from 1975, there was a return of 7.9% per year. In the best case, a good 14%, in the worst only 1.3%. The differences increase the shorter the investment period. If you invest for a longer period, the risk of such outliers becomes smaller. The second reason for long-term wealth accumulation is the compound interest effect. If you reinvest your returns year after year, then once you have earned them, they keep earning new returns year after year. This means that the longer you invest, the more noticeable this effect becomes. And that is another reason why you should start building up your asset as early as possible. Invest regularly. Building up wealth is not a short-term project. It is not a one-time thing. It is best to anchor saving and investing firmly in your life. If you have put your finances in order and have money left over to invest on a regular basis, then you should really invest in regularly. With a savings plan, a certain amount is usually invested automatically every month. Once you have set it up, you no longer have to think about it. The set amount is automatically withdrawn from your account and invested for you. Savings plans are available from low rates. With the Scalable broker, for example, you can invest in ETF savings plans for as little as €1 a month. This means you don't need a huge monthly sum to regularly contribute to your wealth accumulation. The rate in the savings plan can be adjusted at any time. If you have more money left after the end of the month, after a salary increase, you can increase that rate. If you find you don't have enough, you can lower it. And if you have nothing left at all, you can simply suspend the savings plan. Another advantage of regularly paying in small amounts with a savings plan is you don't have to worry about the right time to start. You don't have to worry about whether prices are high or low. You buy more or less fund units with the fixed amount you have chosen. Those were our 5 tips. You have now seen that investing money is not so complicated if you consider a few basic things beforehand. Put your finances in order, be aware that in the long term it can be worth taking a certain risk. Spread the risk. Regard wealth accumulation as a long-term project and invest regularly. I wish you much success. Thank you for watching and see you next time.